Hello, I'm John Lovell, Director of Capital Allowances Valuers, Lovell Consulting. I have over 30 years experience in this area day to day, so I will be trying to draw on that experience in this very quick bite-sized review. The law clearly is up to date as of June 2026, and there have been some recent changes which were presented in the November budget by Rachel Reeves. And let's just go through some of the key ones that have changed. So the big change, probably that surprised most advisors, was the reduction in the main capital allowances rate from 18% to 14%. That applies from 1st of April 2026. So there is a hybrid rate for periods up to that point. This was to some extent compensated by the new 40% rate, which applies for leased assets. There had been some lobbying on this point, some hints that there might be a concession for leased assets. Please do note that the new 40% rate only applies to new expenditure. So if it's second-hand plant, you'd have to use the AIA. So it's not completely brilliant, but it's better than the situation it was before. And it only applies to, it does actually apply now to individuals and partnerships. So those were the kind of big change. The other ones you'll be familiar with. And the satisfying point is that decontaminated land relief, which had been talked about scrapping, has for the time being been retained. And just putting these rates in context, it's probably never been so complex now to categorise plant. And I have quite a bit of sympathy for accountants, tax advisors, even as a specialist. You can't always give them each a very quick answer. And just look how many rates there are just for plant and machinery. I won't go through all of them, but let's just pick one. So if the company maybe has a crane, so let's suppose it's a construction company, maybe it leases it to connected companies or third parties. Before the recent change, it could only claim the AIA, but it can now allocate, if it's a new crane, to the new 40% first year allowance.